Investing in Commodities for Beginners. Welcome to Be a Baby Billionaire. Navigating the dynamic landscape of commodities markets requires a keen understanding of their intricacies, risks, and opportunities. As tangible assets form the backbone of global industries, commodities present a unique avenue for investors seeking portfolio diversification and potential returns. From energy resources like crude oil to precious metals like gold, and from agricultural staples like wheat to industrial metals such as copper, the scope of commodities is vast and multifaceted. In this comprehensive exploration, we delve into the fundamental principles underpinning commodities trading, from the categorization of commodities to the nuances of investing in physical assets versus futures contracts. We'll dissect the factors influencing commodity prices, from supply and demand dynamics to the far-reaching impacts of geopolitical events and economic indicators. Furthermore, we'll unravel the intricacies of risk management techniques vital for safeguarding investment capital amidst the inherent volatility of commodities markets. 1. Understanding commodities. Commodities represent a vast array of raw materials and primary agricultural products that are traded in global markets. These tangible assets are the foundation of many industries, playing a crucial role in manufacturing, construction, agriculture, and energy production. Examples of commodities include crude oil, gold, silver, corn, wheat, coffee, and natural gas. Unlike stocks or bonds, which derive their value from financial performance or interest payments, commodities have inherent value based on their utility, and scarcity is essential for navigating this unique segment of the financial markets. 2. Types of commodities. Commodities can be categorized into several broad groups based on their characteristics and usage. A. Energy. This category encompasses commodities related to energy production and consumption, such as crude oil, natural gas, gasoline, and heating oil. B. Metals. Metals include both precious metals like gold, silver, and platinum, as well as industrial metals like copper, aluminum, and steel. Precious metals are often used as stores of value and for jewelry, while industrial metals are vital for manufacturing and construction. C. Agricultural products. Agricultural commodities consist of crops such as corn, wheat, soybeans, coffee, sugar, and cotton. These commodities are essential for food production and consumption worldwide. D. Livestock and meat. This category includes live animals such as cattle, hogs, and poultry, as well as meat products like beef, pork, and poultry. Livestock commodities are crucial for the food industry and can be influenced by factors such as weather, disease outbreaks, and demand trends. Exploring these different categories helps investors understand the diverse nature of the commodities market and the unique dynamics affecting each type of commodity. 3. Benefits and risks of investing in commodities. Investing in commodities offers several potential benefits, including portfolio diversification, inflation protection, and the potential for high returns. Commodities often have a low correlation with traditional asset classes like stocks and bonds, making them an effective way to spread risk and enhance overall portfolio resilience. Additionally, commodities tend to perform well during periods of inflation, as their prices may rise along with the cost of goods and services. However, investing in commodities also comes with inherent risks. These risks include price volatility, exposure to geopolitical factors and supply chain disruptions, and the complexities of commodity futures trading. Moreover, commodities do not generate income like stocks or bonds, so investors must carefully consider their investment objectives and risk tolerance before allocating capital to this asset class. 4. Factors influencing commodities. The prices of commodities are influenced by a variety of factors, including supply and demand dynamics, geopolitical events, economic indicators, and market speculation. Supply factors refer to the availability of a commodity, which can be affected by factors such as weather conditions, production levels, technological advancements, and geopolitical tensions. Demand factors relate to the consumption of a commodity, driven by factors such as population growth, economic development, industrial activity, and consumer preferences. Market dynamics, including speculation, trading volumes, and investor sentiment, also play a significant role in shaping commodity prices. Understanding these factors and their interplay is essential for investors seeking to analyze commodity markets and make informed investment decisions. 5. Diversification strategies with commodities in investment portfolios. Diversification is a fundamental principle of investing, and commodities can play a crucial role in diversifying investment portfolios. By adding commodities to a portfolio, investors can potentially reduce overall portfolio volatility and enhance risk-adjusted returns. Diversification strategies with commodities involve allocating a portion of the portfolio to different types of commodities, such as energy, metals, agricultural products, or a combination thereof. Investors can consider using commodity-related investments alongside traditional asset classes like stocks and bonds to achieve further diversification. It's essential to carefully assess the correlation between commodities and other portfolio holdings to ensure effective diversification and risk management. 6. Choosing the right commodity investments. Selecting the right commodity investments requires careful consideration of various factors to align with investment objectives and risk tolerance. A. Market trends. Analyzing supply and demand dynamics, price trends, and market sentiment can help identify opportunities in specific commodity markets. B. Risk profile. Assessing the risk-return profile of different commodities and investment vehicles is crucial for determining suitability within the portfolio. C. Liquidity. Considering the liquidity of commodity investments, such as exchange-traded funds, ETF, or futures contracts, ensures ease of trading and price discovery. D. Storage and handling costs. For investors considering physical commodities, evaluating storage and handling costs is essential to understand the total cost of ownership. E. Regulatory environment. Understanding regulatory factors, including trading regulations and tax implications, can impact the attractiveness of certain commodity investments. By carefully evaluating these factors, investors can make informed decisions when choosing commodity investments that align with their investment goals and risk preferences. 7. Investing in physical commodities versus commodities futures. Investors interested in commodities have the option to invest in physical commodities or commodity futures contracts, each with its pros and cons. Investing in physical commodities involves purchasing and holding tangible assets such as gold, silver, or agricultural products, while physical commodities offer direct ownership and potential hedging benefits against inflation. Storage costs, security concerns, and liquidity constraints can be significant drawbacks. On the other hand, investing in commodity futures allows investors to gain exposure to commodity price movements without owning the underlying assets. Futures contracts offer leverage, liquidity, and ease of trading but come with risks such as price volatility, margin requirements, and the potential for losses. 8. Impact of geopolitical events and economic indicators on commodities. Geopolitical events and economic indicators can have significant impacts on commodity markets, influencing supply and demand dynamics, investor sentiment, and price volatility. Geopolitical events such as conflicts, trade disputes, and regulatory changes can disrupt commodity supply chains, leading to supply shortages or disruptions. Economic indicators such as GDP growth, inflation rates, and interest rate decisions can affect commodity demand and pricing trends. For example, strong economic growth typically boosts demand for industrial commodities like oil and metals, while inflationary pressures may drive up prices of agricultural commodities. Understanding the interplay between geopolitical events, economic indicators, and commodity markets is essential for commodities investors to anticipate price movements and make informed trading decisions. 9. Long-term versus short-term investing in commodities. Investors in commodities markets can adopt different investment horizons, including long-term and short-term strategies, each with its unique considerations and challenges. Long-term investing in commodities involves holding positions for extended periods, typically driven by fundamental factors such as supply and demand dynamics, inflation expectations, and macroeconomic trends. Long-term investors may focus on building diversified portfolios of physical commodities or commodity-related equities to benefit from secular trends and capitalize on potential price appreciation over time. In contrast, short-term investing in commodities emphasizes capitalizing on short-term price fluctuations and market inefficiencies. Short-term traders often utilize technical analysis, momentum strategies, and leverage to exploit short-term trading opportunities in commodity futures markets. Whether adopting a long-term or a short-term approach, commodities investors must carefully assess their risk tolerance, investment objectives, and market expertise to develop effective trading strategies and achieve their financial goals. 10. Understanding commodity futures contracts. Basics and terminology. Commodity futures contracts serve as agreements to buy or sell a specific quantity of a commodity at a predetermined price on a future date. Traded on regulated exchanges, these contracts are standardized, facilitating price discovery and risk management for market participants. Each futures contract outlines key details such as the commodity being traded, the quantity, quality specifications, delivery date, and delivery location. Essential terminology associated with commodity futures contracts includes terms like long position, which signifies a commitment to buy the commodity in the future, and short position, indicating a commitment to sell, while the settlement price determines the final price at which the contract is settled. Margin, the initial deposit required to enter into a futures contract. Understanding these basics and terminology is vital for investors aiming to participate effectively in commodity futures markets. 11. Summing it up. As we conclude this exploration into the intricate world of commodities, we've uncovered a wealth of knowledge essential for any investor looking to navigate these dynamic markets. From understanding the foundational principles of commodities trading to unraveling the complexities of commodity futures contracts, we've embarked on a comprehensive journey. Armed with insights into the diverse categories of commodities, the factors influencing their prices, and the benefits and risks associated with investing in them, you're equipped with the tools to make informed decisions in this unique segment of the financial landscape. Whether you're considering long-term investments in physical commodities or exploring the opportunities presented by commodity futures contracts, time for the soft question. What commodities do you plan to invest in or are currently investing in? What are your favorites and why? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.